Hello and welcome to Econoday Unplugged. It's Tuesday, the 19th of September 2019. Mark Pender is across the pond stateside, and I'm Jeremy Hawkins here in London. Well, last Thursday we saw the ECB deliver its latest easing package, although it remains to be seen just how effective it's going to be. And this week it's the turn of the Bank of Japan, the Fed, the Swiss National Bank and the Bank of England. With that in mind, the weekend's attacks on Saudi oil fields and the subsequent initial 20% jump in oil prices have added an extra layer of uncertainty to the global economic picture and poses a question, I guess, will the spike have any implications for central bank policy? On which note, it's FOMC time. So, Mr. Pender, it looks as if market confidence in a Fed cut tomorrow had already faded a little bit anyway. Do you think this bounce in oil prices will hit prospects anymore, or is it neither here nor there?
Well, it's probably neither here nor there, and that's basically just, I think, how the Federal Reserve makes its assessments. It, steps back from jumping to conclusions, as it were, and we really don't know how long this interruption will be in oil production. I guess there's reports out of Saudi Arabia that it might be coming back online sooner than expected. We'll have to see whether or not there'll be any more attacks. So I don't think it'll be really a front and center issue that would make the statement, for instance, tomorrow's FOMC statement, although it'll certainly be a topic of discussion at the meeting and as well as at the press conference following which. But I think expectations are really very almost universal that there'll be a 25 basis point cut. The real question will be will it be described as a continuing policy adjustment, or is this a pivot to a lower trend for interest rates? And I think that's where the mystery will lie. The FOMC forecast will be also published, but unlike the ECB, Jerome Powell has diminished the importance of these forecasts. They don't really are not as front and center for you to be able to calculate how many rate cuts the Fed will be doing with certainty. Certainly not in cement. I guess there's expectations that there'll be one more for the remainder of the year, and whatever it's worth, maybe a couple more for next year, although that's completely up. It will be more important how Jerome Powell describes the current rate policy than what those forecasts will show. It's like you say, it is a rush of central bank meetings, and I have my eye on the Swiss National Bank personally because they're already in deep negative territory, and if they go another step into that, which is possible, that would, I think, accelerate this global shift to stimulus. What do you think, Jeremy?
Yeah, I think it's a good call. I think, typically speaking, the Swiss National Bank, which meets on Thursday, so the same day as the Bank of England over here, typically, I suppose it tends to get overlooked and the concentration tends to be on, certainly within Europe anyway, the ECB and the Bank of England. But you mentioned this week it could be quite interesting. So just to put this into context, the Swiss National Bank's monetary policy at the moment really revolves around the level of the Swiss franc and crucially, the level of the Swiss franc against the euro. So as we speak, euro Swiss franc, so Swiss francs per euro stands at just below 1.10. Now, the belief has been within the marketplace that as far as the Swiss National Bank's pain threshold for its currency, it's round about the 1.15 level. So in other words, the Swiss franc is already about 5% or so too strong as far as the SNB is concerned. Indeed, for people with good memories, they may recall that the National Bank used to have a target floor for euro Swiss franc all the way back at 120. So we're best part of 10% below that. Now, that means then going into this meeting, there's sort of speculation, well, perhaps they'll come out, as you mentioned, they already have negative interest rates. Their policy rate stands at minus 0.75%. Having seen the ECB trim its deposit rate last week by 10 basis points, perhaps they'll come out and do something similar or indeed make a bigger move with a view to try and weaken its currency a little bit. But I think as far as it's concerned, there's been a lot of political pressure on Switzerland from the politicians and parliament who really don't like the idea of having negative money market rates. And indeed, in Switzerland, they've been negative for a long time now. Of course, we've had the same sort of problems that the ECB's been facing with negative interest rates at the end of the day. They hurt savers, and in particular, they also hurt banks' profit margins. So were the SNB to go further into negative territory, again, is going to put added pressure, added costs on the banks themselves. So I think, will they go or won't they go? Well, I must say, I think had the euro weakened significantly on the back of the ECB's last week, then I think the Swiss National Bank would probably have to just bite the bullet and say, OK, we're cutting as well. But in practice, the response from the currency market to the ECB's moves has been relatively mild. And in fact, if we look at euro Swiss franc at the moment, I said we're trading about 1.10. So that's about a percentage point or so stronger than we were before the ECB's announcements itself. So in other words, the SNB, if it wants to, has really got the option of keeping its powder dry and keeping what would be perhaps an emergency additional cut in interest rates until such time as we see, if indeed we do see, the Swiss franc strengthen significantly further.
Well, what does the SNB do now in those pre-meeting or those in-between meetings? Let's say there is a rush to buy. There's a lot of troubles in the world, of course. And what happens if there is a rush to buy the to buy the Swiss franc? Would the bank come in between? Do they make statements? Do they just quietly intervene in the foreign exchange markets? What do they do?
Well, okay, there's two things they can do. One, they could actually come out and change policy rates between their scheduled central bank meetings. They've done that before, and indeed, when they actually abandoned their Swiss franc target floor, were a lot of other central banks around the world who were extremely unhappy with the move because it caught everyone completely on the blind side. And we saw a huge, 20 to 30% fall in the value of the Swiss franc. Didn't last that long, but nonetheless, it led to extreme levels of volatility in FX markets. But anyway, it does mean that the the SNB, the Swiss National Bank, can change policies between its allocated meetings. More likely, though, at least as a first round measure, it will do, in fact, what it's been doing for the last few months, and that's to intervene in the FX markets. So on Thursday, whether we get any cut in interest rates or not, you can bet your bottom dollar or your bottom franc, whatever takes your fancy. What they will do is to very much reinforce that they're unhappy with current levels of the Swiss franc, and they're more than happy to intervene as necessary to cap its appreciation. Now, looking at, it's difficult to get hold of intervention numbers, but there's a couple of proxies you can use looking at SNB sight deposits or their foreign currency reserves. And from changes in those over the last couple of months or so, especially since the end of July and beginning of August, when the franc really has appreciated quite sharply, those reserves have gone up significantly. So all the signs are that, in actual fact, the Swiss franc might be perhaps significantly stronger than it is at the moment, had the SNB not been intervening. So I think they're really active in the market at the moment.
And their style or their strategy for their interventions, do they catch the market off guard and then intervene without making a statement?
Sorry. Yeah, they do. The way they operate, in fact, typically speaking, a lot of central banks will say, look, we're intervening purely with a view to, the kind of a psychological factor that can have in a marketplaces itself. If a central bank is on the other side of the market, then you're going to be that much more reluctant perhaps to do what you can do on your side of it. However, for the SNB, they hardly ever make any comments on intervention policy. They'll say they're prepared to intervene as and when they see fit, but pretty well speaking, that's it. When they do intervene, simply don't tell anyone.
And the press doesn't pick it up?
Well, the press, I think, like sort of economists and analysts, will look at what's going on in terms of their weekly sight deposits, which say it's a proxy for intervention. It's not a perfect measure, and use that with a view to trying to determine whether or not they've been active in the market or not.
So that's interesting. The news agencies aren't calling the foreign exchange desks at the different bank and getting info and asking questions. Is the bank in, stuff like that?
Well, I think they must do, but I guess there's various unwritten rules as to what the individual banks themselves are allowed to say.
Yeah.
On that, let me just sticking with the central bank thing for a moment. So there's all these central bank meetings going on at the moment. We know that last week's ECB meeting, and I might chat a little bit about that in a minute, but we know from what Mr. Draghi was saying, it was not a unanimous vote to launch the package of measures that they chose to. What about the FOMC on Wednesday? Is that going to be unanimous or not?
Well, that's interesting, right? The last one was 7-2, 2 against the rate cut. Whether or not they will move into the fold is uncertain. There's cross currents going on right now in the economic data in the U.S. We just had industrial production this morning, and it was much stronger than the best showing of the year suddenly. And a lot of the business equipment, capital goods areas, which are the center of the Fed's focus, they're concerned about slowing business investment, given export slowing and stuff. And so this was a very positive. Is it just one report though? But then you have stuff like consumer price, core consumer prices. 3 months in a row, the CPI core has been at 0.3% monthly gains, and this is like the first time of the expansion. So this is an important signal. This corresponds. You had some wage pressures in the UK last week. Well, average hourly earnings have not only posted their own 0.3% monthly gains, which is on the strong side, topped in August by a 0.4% gain, if we remember. So there is the inflation curve is not in the favor of the Dubs right now, and whether or not something like the industrial production report probably will get a significant reading in today's FOMC, and they'll make it's a 2-day meeting. They'll make their announcement tomorrow. But there are cross currents, probably enough to keep the hawks unconvinced. Whether or not they want to fold in and circle the wagons for the institution, that's another question. And maybe Jerome Powell, if he his first year and a half there, he had no dissents whatsoever, and now he's facing that. So it'll be interesting to see if he can move them in. We'll have to wait. There's also the possibility. Remember, we were the Fed had been talking about when they get their low rates. One of the theories was that you have to then, because you have less room to go, you should make a mad attack. With heavy artillery fire and hit it with a 50 basis point cut. Well, that isn't being talked about anymore. But is the Fed going to gradually, if this is a trend now, are they just going to be gradually moving incrementally towards zero, or are they just going to, do what they had talked about in theory as a possibility of making that outsized move? So I'm, we have to write this stuff and we have to report this stuff. And so I have, when the announcement comes out, I'm going to have my ear open to see whether or not it's a 50 basis point move right at that moment, because I think that is an outside possibility.
Interesting. Well, talking of incremental, just a quick whiz through what the ECB did last week, because it was potentially significant. It was a package of measures, as we mentioned. So the deposit rate then was cut by 10 basis points. So I've got to wonder, really, was it worth it? But anyway, 10 basis points down to minus 0.5%. As we talked last week, that increases the cost on banks who pay this rate to park their excess reserves at the central bank. So the central bank's introduced a new 2-tier system, which means that not all those excess reserves are going to be hit, and the ones which aren't will actually receive, well, they won't receive anything, but it'll be a 0% interest rate. No real surprises there, apart from the fact that some parts of the market were hoping for a larger cut. Also, we're going to return to good old quantitative easing. So that'll be back from the 1st of November at 20 billion euros a month of net asset purchases. So that's only 5 billion a month more than they're running at when they concluded the program at the back end of last year. However, it is going to run for as long as necessary. So it's open-ended, and that certainly, I think, caught some people by surprise. The other main news outside reinvestment policy, which is unchanged, was the change to forward guidance, and that has been modified. So now they're talking about rates remaining at their present or indeed lower levels until inflation has converged close to its 2% mark. And with convergence that's been consistently reflected in underlying inflation dynamics, to quote the ECB. So in other words, we've always talked about the core measures of inflation being important in terms of looking at month-on-month numbers. Increasingly now, they're suggesting that the underlying HICP, and we'll get an update on that tomorrow, is going to be increasingly important in terms of what they do with their policy. So it's important for investors to keep an eye on that.
Jeremy, I have a quick question. Yeah. What assets do the ECB buy?
Well, they've been buying mainly government securities, and from what they said last week, that's still going to be the case. They do have some mortgage-backed securities, they do have some corporate bonds, but by and large, it's been sovereign debt. And one of the issues,
European sovereign debt.
Yeah, European sovereign debt.
Yeah. Mm-hmm.
And one of the issues of this, of course, and something which I think there's still a question mark hanging over at the moment, is they bought so much of this blooming stuff. So they have what they call their so-called capital keys, which sets the limit for how much they can buy from, let's say, Italian BTPs or German bunds. Well, in the case of the German bund market, they're starting to nudge up towards the upper limit. So they may have to do something about that, which again has got people wondering if this thing's open-ended, as they say, is this quantitative easing program. They may have to change something somewhere else. They're soon going to run out of stock to buy. Right, quickly moving on there. So we talked about the SNB. Bank of England we can get through quite quickly. Thursday, no change again there. Why? Well, basically, as everyone knows, there's still this Brexit cloud of uncertainty hanging over the policymakers. Realistically, I think the only possible move could be on the tightening bias. If folks remember, the Bank of England still retains this tightening bias. It could be moved, it could be taken out given uncertainties about the global economy. But as Mark mentioned, we have had some strong wage numbers both in June and July over here, which caught people by surprise. And importantly, too, the July GDP data, they showed an increase of 0.3% on the month, which kind of makes a recession this quarter look that much less likely. So chances are, I think, that they'll leave the tightening bias in for the time being. For financial markets anyway, as ever, they're more focused upon Brexit developments, and for now that means the Supreme Court in the UK, where judges will be ruling probably in 3 days' time on the legality of the Prime Minister's decision to suspend Parliament. It's not clear at this time which way it's going to go, but note that Boris Johnson has been saying that it's not necessarily the case that he'll abide by the outcome if he loses. If so, it's not really certain what he'll do. I mean, he may have to recall Parliament, but then on paper he could just come out and suspend it again. Who knows? That's certainly something we still have to watch closely. But were he to lose this ruling, then I think there's an increasing sense that the Prime Minister may be forced to quit. So UK politics still very much in the headlines over here.
Now, speaking about UK politics, has there been a shift? When Brexit first appeared, it seemed to have been across party lines. Now, has the Tories, have they become the de facto Brexit party, and Labour now is the Remainer?
As far as the Prime Minister Johnson's concerned, he wants really exactly that. He wants the Tories to be the de facto Brexit party. However, you do still have massive political divisions across the parties. So, as we know, as we talked about, I think, last week and then previous weeks, at the end of the day, there is no parliamentary majority, and in part this is due to a big swathe of Conservative Party members who want to see Brexit without a deal. I think if Johnson can come out somehow and secure a deal with the EU before the 31st of October when we're due to leave, then Parliament, I suspect now, would almost come out behind him. And Brexit then would be effectively signed, sealed and delivered. But as things currently stand, we've seen over 20 MPs from the Tory party quit and form either independent parties or join the Liberal Democrats in protest over Johnson's stand. So it's definitely not the case that the Tories are the hard, clear, fast Brexit party. At the same time, across on the opposition benches, the main Labour Party, the main opposition party, they're kind of split. In theory, their line now is supposed to be that they want to hold a second referendum, but some people on their MPs are saying, well, look, we don't think there should be a second referendum. Liberal Democrats, most of those are saying, well, we want to stop Brexit as soon as it happens, but it's not completely clear that all the members agree with that line as well. So, I mean, this is the issue. If there were an election next week, deciding who you want to vote for to take on board, where you think Brexit should be, would not be an easy position to really to deal with.
Is that why Labour didn't want the election, because they know that they would lose?
Well, I mean, it's interesting. If you look at the opinion polls over here, they've been suggesting that under Boris Johnson, whatever you think of the character, the Tories have opened up a lead around about 8 to 10 percentage points, which is one reason why there was this speculation that Johnson was trying to push for an early general election, win a mandate, from the people and say, well, that's it, I'm doing whatever I want with Brexit, so probably no deal. And that, of course, was the key reason why the opposition parties got together and prevented Johnson from getting his early general election. Fascinating times, it really is. Mm-hmm. Right, before we say prattle on for too long, I should also quickly mention the Bank of Japan. Overnight, the BOJ would make in its policy statement. No change really expected in their short-term interest rate target of minus 0.1%, or the, unofficial target range for 10-year JGB yields of minus 0.2 to plus 0.2%. But again, even if they don't do anything, expect the general tone of the statement to be very dovish, because most previous meetings, they've been making noises to the effect that they're more than happy to do something on policy if we don't start to see some improvement in the real economy and a pickup in inflation. Right, so virtually everything seems to be talking about interest rates are on hold or going down, by and large going down. So we'll just mention on Thursday we get the Norges Bank, not often talked about perhaps much outside Scandinavia, but there's a reasonable chance they'll actually be hiking interest rates out there by another 25 basis points to 1.5%. Indeed, they've been raising interest rates since the back end of 2018. Good on you, Norway. All right. Anything else? That's probably enough for us, I think. Before people start nodding off. Okay, right, so let's end it there for today then. But of course, we'll be back again next week as usual. From Mark and myself, thanks as always for listening. Do keep an eye on Econoday's global economic calendar, and we'll see you next time. Bye for now.